And so I believe a significant illiquidity process is emerging. And it will only become more evident as time passes. And I think that is a deflationary event. And
All
I
right.
think the Federal Reserve is behind the eight ball, well, way behind the eight ball.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. It's an especially confusing time for investors given how divided the experts are on whether resurging inflation or disinflation deflation is more likely from here. Your answer to this question determines whether you think the Federal Reserve starting to cut interest rates is a good idea or not. Today's guest has very strong views on this matter based on a lifetime of study. For perspective, we've got the great fortune to sit down with one of the greatest living economists, Lacy Hunt, former senior economist for the Federal Reserve Bank of Dallas and current executive vice president of Hoisington Investment Management Company. Lacy, thanks so much for joining us today.
Glad to be here. Nice to see you, Adam.
Always wonderful to see you, Lacy. Thanks so much for joining us. I know I stand between you and your Labor Day weekend, so we'll wrap this up as quickly as we can. And first and foremost, I just want to let folks know we're going to talk about your thoughts on current Fed policy here, Lacy, but this really is just the appetizer, even just the amuse-bouche, if you will, to your appearance coming up at the Thoughtful Money online fall conference, where you give really a graduate level walkthrough on where you see things headed from the macro perspective. You walk through a ton of charts that you create specifically for that event. So, I'm not going to dig too deep with you on these issues because we're going to get a chance to do that in real depth at the conference. That being said, let's get started
I
here.
might go deep, however.
You do whatever you want, Lacy. You always have carte blanche to do whatever you want. So let's kick it off here. What is your current interpretation of the status of fiscal policy today?
In one word, it's extremely restrictive. And I know that that's not the general view, but let's look at some of the facts here. So, according to the Congressional Budget Office, the Big Beautiful Bill Act will add $3.4 trillion over the next 10 years. That's 340 billion per year. However, embedded in that number are roughly $3 trillion of, let's call them accounting tax cuts. Accounting as in terms of stipulated by the law and the procedures of the Congressional Budget Office. And in addition, there are $3 trillion worth of expenditure reductions. So the net increase in federal stimulus measured in this very narrow sense for the 10-year period is $400 billion or 40 billion per year. However, that is while all factual, not very useful. Now, the S&P Global, who recently reaffirmed the credit standing of the United States, said that the fiscal situation is stable, that it's neither improving nor deteriorating, in spite of the calculations of the CBO. And the reason that they said that is that it looks like a reasonable assumption is that over the next 10 years, tariffs are going to add $3 trillion in revenue or $300 billion per year. And so if you have a net 3.4 stimulus and you have $3 trillion in tariff revenues, you're almost in balance, more or less. One
Hmm.
washes each other. Um, but that is a simple mathematical calculation that is not the dynamics of the economics. And the reason is that of this 3.4 trillion in stimulus in the big beautiful bill act, is that $3 trillion was a mere rolling over of the 2017 tax cuts.
Right.
The tax rates that are in effect this year and went into effect 8 years ago are the same tax rates that will be in effect in 2026 and for the 9 years afterward. So there's no net benefit in any sort of macroeconomic sense from extending the tax cuts.
Hmm.
So the way I look at it is that there is roughly $3 trillion of expenditure reductions plus the restrictive effect of $3 trillion over 10 years in tax revenues. Now, and that's why the S&P Global can say that they're in balance. But the matter of fact is that even there, the calculation is too simplistic because there are many dynamic effects that are going to take place as a result of the tariff increases. And this is what I want to talk about.
All right.
The main feeling is that the tariffs are being absorbed and there hasn't been any significant damage yet. But I would not share that view. The way the tariffs work out historically, it's a very, very slow process. It goes through multiple stages. Um, the first act of raising tariffs is not the final act when there is retaliation. And if the parties that the instigator country and the retaliator country are not happy, you may have second, third, and fourth round of tariff increases in retaliation. And we're seeing
Yeah.
that
The whole tit for tat. Yep.
the whole tit for tat game goes on. Now, so the other thing that we have to take into consideration when we're talking about tariffs is the nature of the goods that are in the international flow. And the bulk of them, with the exception of certain energy products like gasoline and life-saving drugs and maybe some life-saving medical equipment and perhaps a few rare earth minerals. The all of the rest of the goods are highly price elastic.
Hmm.
In other words, if you raise the price, you get a much larger percentage decline in demand than you would for the average product that would be traded uh, on a global basis. And
Right. Because
so
people can either forego it or they can choose substitutes. Yeah.
they can. Well said. Time is very important. Time can be a substitute. Um, and you can also shift to older equipment, for example,
Hmm.
or you can rearrange the production process, or maybe you can find a way to simply modify and amend what you're working with. And so the whole process is we're dealing with price elastic goods, and I personally would say that for most internationally traded goods, excluding the ones I mentioned, the price elasticity is 3, which means that a 1 percentage point increase in price reduces demand by 3%. So let's think about this in another way. Last year, the imports of goods were 3.3 trillion. And right now, it looks like here in August that the tariff rates in already in place are somewhere around 10%. So without allowing for the dynamic effects, 10% times 3.3 trillion is more than 300 billion per year.
Yep.
3 trillion over 10 years. That's why S&P can say the fiscal situation is in stability. However, um, when a country with dealing with price elastic goods, if they institute tariffs, there's retaliation because of the flatness of the curve. What happens is that prices go up initially, quantity demanded falls. If you use the micro model,
Mm-hmm.
the retaliation occurs, quantity demanded falls further, and the price level falls back. Now, the Fed Chairman Powell has only talked about the first round effect. And the first round effect can go on for months. But there is a second round, and because of this highly price elastic curve, the first effect, which starts slowly and then builds, is that there is a very significant margin squeeze because firms cannot push the price increase through rapidly.
Yep.
They would lose market share substantially, and people have options as to deferring demand or moving to other products or simply not buying at all. And so this margin squeeze, as it slowly materializes, causes a downward, or what I would call an endogenous shock to liquidity. And most of us assume that the Federal Reserve controls liquidity. Liquidity is an exogenous element. But no, this is one of those times, as demonstrated by the period from 1925 to 1939, that the imposition of tariffs can have several rounds of a negative liquidity effect. Economists like to use the term endogenous. So the first occurs when corporations experience the loss in liquidity because they sell less or have to take lower price or combination of both. But to get their house back in order, firms have to cut the demand for the factors of production, which would be labor, natural resources, and capital.
Mm-hmm.
And when they do that, then that causes another downward shock to liquidity. And of course, if the process is playing tit for tat along the way, the whole element is going on and on. But there's still another effect, which no one is talking about at all. Is the objective here is to raise tariffs and to improve the trade sector. However, the trade sector is the inverse of the capital account. And capital account is the same thing as net foreign saving. And so if you improve the trade deficit, you worsen the capital account.
Hmm.
Now, the capital account is in the saving of the foreigners that have by necessity plowed back into the United States because they want to sell us more goods than they want to buy from us, has resulted in the fact that the foreign sector owns 18 trillion of common stocks, of equities. They own 5 trillion of corporate bonds. I'm doing in round numbers here. They have 2 trillion of government mortgage paper, and they have 8 trillion of US treasuries. So when you improve the current account, the capital account is going to deteriorate. And there are going to be less funds for all of these uses that the foreign sector has been supplied. Because what has been the role in the past is we get goods and they get IOUs in the form of ownership of U.S. firms and directly through equities, indirectly through bonds, and by vesting in other types of fixed income instruments in the U.S. And when the capital accounts begin to flow, that results in another downward exogenous shock to liquidity. Now, I'm not the one that thought of this. I wish I had. The whole process was originally described by the great Charles Kindleberger in his famous book, The World in Depression, 1929 to 1939. Now, Kindleberger is well known for his book, Manias, Panics, and Crashes.
Mm-hmm.
But he wrote about 20 different books in economics, including the one on the Great Depression. He also wrote the leading text, graduate text in international economics. It's now in its fifth or sixth edition. The World in Depression is probably in its fifth or sixth edition. I don't know exactly which one. But these endogenous shocks to liquidity create what Kindleberger, the process that he described, has been described by others as the Kindleberger spiral. So the tariffs, as they go on, reduce liquidity. Now, in the period there of the 20s and the 30s, the Bank of England had always in the past acted as the world's central bank. But they couldn't do that because they had basically been emaciated by World War I. The US was actually in position to take over and be the world's central bank, but they didn't want to take that role. And so as world liquidity was collapsing, the central banks were sitting on their hands and allowed this downward spiral of liquidity to occur. And so we've seen action by the EU, we've seen actions by the Bank of England, but the central bank of the world, because the US is the world's reserve currency, is still the one that counts. And so I believe a significant illiquidity process is emerging. And it will only become more evident as time passes. And I think that is a deflationary event. And
All right.
I think the Federal Reserve is behind the eight ball, well, way behind the eight ball.
Okay, and just get into the punchline real quick, and I'll let you expound on it in a moment. But when you say the Fed is really behind the eight ball, presumably then not only do you think they should be cutting, you think they should be cutting by a lot more than perhaps just 25 basis points.
No, I think it's going to take a lot. I said, I was with you earlier. I said I thought they needed to cut by 100 basis points this year. And I think they still need to do that. They should have done it before now, in my opinion. And by the way, I said that before the president did. I don't want anyone to think I'm shilling for President Trump. But I believe that the case is there, that this process is potentially very tenuous. And there needs to be significant central bank action here to offset what is going on globally.
Okay, and just to help folks appreciate the situation, let's say this was you're a fireman here and you're trying to rate the fire, right? Is this a one alarm fire or a five alarm fire at this point in time in terms of the urgency of the action needed?
I would say it's already a second or third alarm, but it's not putting off any smoke yet.
Mm-hmm.
And central banks like to say they're data dependent, but data is always backward looking.
Right. That's why they always criticize it for being too late. Yeah.
But you see, this is a unique situation the only other time that this ever happened was between 1929 and 1930. By the way, um, Kindleberger was of the view that the whole period was one of depression. And the only thing that ended it then was when the German tanks moved into
Yep.
Poland in 1939, which ended the process. And this has many um, similarities to me,
Okay. Well,
very many similarities.
let's hope the similarities don't evolve to being that similar. I don't think anybody would love to see another world war come from here, though I understand that, maybe that's a risk that's on the table. But back to my sort of question about what sort of severity are you ringing this bell with right now? Uh, if we don't act or we take the wrong actions here, Lacy, like how worried are you about what the outcome would
Well,
be?
if it, let me just say this: if it were
Because
me,
because deflation isn't fatal. We have recessions from time to
we
time.
do,
I don't get the
we
sense you're worried about a garden variety recession, though.
no, I think it. I think that it is potentially serious enough. An ultimate outcome is deflationary, and um, the matter is very complicated. The tariffs are under constitutional review. They could be declared unconstitutional. I don't know what the outcome will be, but there are other issues that are at play. But I think that it's a sufficient risk that the Federal Reserve in the current situation should ignore the current statistics and look to prevent the negative aspects of a international tariff war of damaging the global economy.
Okay.
They should be moving in it well in advance of the process.
So let me ask you this then, Lacy. I mean, as I said in the intro, you're one of the most accomplished economists alive.
I don't know about
And
that.
I don't say that just to flatter you, but if I can flatter you, I will. But no, I mean, you've had a phenomenal career. Um, but I mean, the Fed has hundreds of PhDs working for it. Some of them have got to have read Kindleberger. Uh, up until this past Friday at Jackson Hole, um, Powell was pretty sanguine this year. Like, how
He
come nobody
continued to call the
there?
labor market strong.
Right. So I mean, so how come nobody at the Federal Reserve has done what you've done, which is just looked at the historical record and said, "Hey, look, Kindleberger respected. He wrote a whole book on this.
Mhm.
It's even called the Kindleberg spiral. Like, are they just ignoring it?
I don't know what they're doing. I don't know how their research is being formulated. I know that one of the things that I don't like about the Federal Reserve that we have the Federal Reserve has the most costly economic research organization in the world. But one of the things that I think that all of us is in the United States, regardless of our political opinions, the virtually all of the economists in the Federal Reserve are neo-Keynesians.
Mhm.
And um, there's an alternative view. It's a neoclassical view. I've sort of fallen into that camp. There's the Austrian view. There's the monetary view, which is a sort of a branch of the neoclassical school. These viewpoints are hardly represented at all. And it seems to me that the Federal Reserve has just settled into this notion that they will be totally data dependent and they will ignore everything else. And uh, but in some cases, I get the sense that the Federal Reserve, if they follow certain indicators and they don't like what those indicators say, then they flip. Um, for example, last year, um, uh, Chairman Powell at one point in time was willing to acknowledge that the quarterly census of employment and wages, the
Mhm.
QCEW, was coming in significantly weaker, or that the monthly payroll number was consistently overshooting. And we know from the QCEW that covered the fourth quarter of last year, there was a massive overshoot in the QCEW. I mean, in the payroll vis-a-vis the QCEW. But the chairman has continued to refer to the labor markets as being strong. And at some point in time in the past, the chairman has acknowledged when there were discrepancies between the household survey and the payroll survey. Well, since January, the household employment is down 600,000. The payroll is up 7. That's a discrepancy of 1.3 million.
Mm-hmm.
There's a lot of reasons that in fact the Federal Reserve is not as data dependent as they appear, and that they appear to seize on the variables that suits whatever their opinion about what they should do, not in fact a reflection of the way things are or the way things will be. I must tell you that I am very unhappy um, with the leadership of the Federal Reserve,
Which is
and
undergoing a lot of
this is on theoretical grounds and not political grounds at all.
yeah. Although I do want to ask you about that in just a moment because there's a lot of drama going on at the leadership of the Fed right now. But let me ask you another question that I just asked the other day. You said it's like the, most expensive research institution in government or whatever.
Macroeconomic research, easily.
Okay. So, and they look at data that appears to be obviously flawed or at least obviously imperfect in its collection, right? So we can see some of the issues with its surveys, right? We've seen tremendous fall off in, I can't remember if it's the household or the establishment survey in terms of response rates.
Households down sharply this year.
Yeah.
January.
And these are these are sampling surveys, right, where they get a small but hopefully statistically significant sample and then extrapolate a lot off of that. And everyone's heard about the birth death adjustments that they do to the models. In 2025, in the digital world, we have the ability to get extremely granular in our tracking. We have data sources out there, tax receipts, like actual, payroll data of who got paid what down to the penny. We now have the blockchain technology and theoretically, which can, kind of atomize all the data that's out there. And the Fed, just went through what, or they're in the process of going through a $2.5 billion renovation of their physical facilities there in DC. It seems to me that with a real small fraction of that, they could build dramatically better data collection systems and have much truer data and probably much more close to real-time data. But I don't see a lot of that underway. Do you have an opinion on that?
I can actually prove what you said is right. For example, the firm ADP, as they actually have a sample of about 22 million employed people, and they are able to take the QCEW data and benchmark the ADP series to every time the QCW comes out.
Mm-hmm.
I don't see the difficulty in transferring a computer file from point A to point B. Not today. And so if ADP can do it with their resources, why are we not able to do that?
Is there a valid? I mean,
It's very valid.
You've worked
I
for the
think
Fed
something
before.
is seriously
But
wrong.
is there a valid reason not to be doing this, or is
No,
it just
there's absolutely none what I know, none whatsoever. Um, uh, for example, uh, we could view we could we could survey um, the top 20 payroll data processing firms in the country,
Mhm.
calculate a sample from them to do the surveying of the small and intermediate sized firms that are not captured by the 360,000 launch firms. I mean, the fact of the matter is they've just been absolutely stationary. And I think that one of the reasons the household survey is working better is that they have a pretty good sample. They're surveying close to 60,000 folks. Um, the last presidential election, there were pollsters that got the results right with a random sample of 1,800. You know, if you have a true random sample, it doesn't matter how large this universe is, the results will be excellent. I mean,
Right.
this is a process that should be much further along. And um, you know, you and I have had discussions about this in the past, and I don't. I personally think that it's bureaucratic failure. I don't believe that it's political. I just think that the Bureau of Labor Statistics is to data collection what the post office is to mail delivery.
Okay. So
That's,
so it's more sort of just bureaucratic
I,
sclerosis,
yeah, I'm afraid so. Misuse of resources.
which
And
is so depressing.
well, you made the point about the Federal Reserve building, $2.5 billion. We're doing that, and we don't have good data.
Well, it's
How
just
can
crazy. Yeah. I mean, why would you even think about doing that uh, until you got your data house in order? If at the end of the day your institution exists to make good decisions, it doesn't really matter how much marble you have around the people doing the work.
no?
Yeah. Okay. Well, that's depressing. Seems like for some reason the Federal Reserve got inspired by Lady Justice and said, "Oh, we should just wear blindfolds here." Okay, well, look, you're tunneling over to the leadership of the Fed. So obviously, we don't have a great opinion of the Fed in terms of its data management and collection practices. Um, but and
Nor
you,
the
and you,
Bureau of Economic Analysis or the BLS. I mean,
yes,
it's just
yeah.
all falling short.
Um,
And you know, I mean, we have this big employment report coming up next Friday. The series is so flawed in the way it's constructed that um, the real tragedy for the economy would be that they continue to get it wrong and they have another massive overshoot of what is the actual truth. Um, Historically, one of the great uh, indicators has been this labor differential as part of the conference board survey. And you know it's fallen for 8 consecutive months, 8 consecutive months, and it's back where it was in 2021,
mhm.
early 2021, and this is massive divergence that developed last year, the year before that. It's continuing. Um, the differential deteriorated again in August after deterioration in 7 prior months. Um, but you know, if the procedure is flawed, it's flawed. But and so when the number comes out, of course, the markets will react to it.
Mhm.
But it doesn't mean that the number is any more valid when the August number comes out than when the July number came or the June number came.
Well, so let me ask you this then, Lacy. So we've 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 got, if I understand you correctly, you think we are kind of hurtling towards a Kindleberger spiral here. But we're kind of blind to it, right?
Right.
I mean, in your mind, hopefully the Fed does start cutting because obviously every delay in cutting just makes what's coming worse. But obviously, until they really get religion around this, they're going to be behind the curve, right? And probably at some point realize that and then start panic cutting, which is sort of what the historical pattern has always been for them. Um,
Could I just say one thing?
yeah.
With you. Um, One of the problems is that the president and the chairman of the Federal Reserve are do not see the way the world politically the same way.
Hmm.
Clearly difference of view. Um, and we've seen this in the past, but the in the final analysis, monetary policy must reflect the true situation of the economy.
Yeah.
And if they don't, then the country is going to be very badly served by that. And so we're in a very, very difficult situation. Um, the the current administration uh, is doesn't like the Fed. Some of that is for political reasons, but what I'm more focused upon are these critical functional areas where there has been misstep after misstep, not just in terms of the last year or 2 years, but for a very, very long period of time.
So let me ask you a question about this then. And I know that there's a lot of discussion right now about, the potential um, political nature of the Trump Powell war, and of course, people like Lisa Cook, now involved in it, voting Fed governor. Um, but there has also been discussion amidst all this, especially from folks like Treasury Secretary Scott Bessent, of saying, hey, it's time to kind of just reevaluate how the Fed works, right? Do you do you have any thoughts, optimistic, pessimistic, or whatever, about this kind of, I don't know if it's a trial balloon or what, that's being raised at this time of like, yeah, we're going to replace, Powell when his term ends next year, but maybe actually say, hey, we're gonna ask ourselves, like, should the Fed operate differently? Is that a healthy thing to raise, and is this the right time to be raising it?
Yes, it should definitely be raised. The problem is that it is such a politically wired issue. I have seen no path to go, no way to take that path out.
Hmm.
Just too contentious, and that's sad for the country.
Okay. So kind of like the data collection, then you just don't think it's going to happen. Reform isn't going to happen on a pace that we're going to be happy with.
No, no.
Okay. All right. Well, let me get back to the question I was in the process of asking, which is, so you see, um, a deflationary period ahead, and right now we have sort of the wrong policy for it. Um, in terms of the important things for the people watching this video, like the employment market, um, what do you see lying ahead, especially if the Fed is too late to this party in terms of its response function? Is this
Well,
going to is
think
this a recession? Is this going to be one where folks are going to be worried about losing their jobs? Are we going to see job shedding eventually?
well, I think that there, if you Piper Sandler um, took the QCW report, which is not seasonally adjusted, and they've seasonally adjusted the QCW all the way back. And by the way, if Piper Sandler can do it, then why cannot the BLS do it?
Right.
And if the BLS wants to tweak the X11 formula that is the normal one used for seasonal adjustment, so be it. But the Piper Sandler seasonally adjusted series shows a sequential decline in the payroll in the fourth quarter from the third to the fourth.
Hmm.
Not big, but that's against a very significant increase. Um, one of the things that my good friend and yours as well, Danielle DiMartino Booth,
Hmm.
really first-rate economist, longtime friend of mine. Um, what she did is she took the payroll, the state payroll data, which is calculated entirely different from the payroll data in the monthly situation report. And she did it for the June, which is the last month that we have available. And uh, based on the state data, the sum of the state data, payroll data declined in June. Well, one of the things that the BLS should investigate is to see whether they could use the state data. It's coming out a little bit slower, but it's available for June. It's a hard count, and it doesn't rely on the birth death model.
Oh. So Lacy, I interviewed Danielle probably about 4 or 5 days ago. And yeah, she shared exactly that. And I think the number for June was a negative job loss of 65,000
Mhm.
with that state data.
Yeah. It's a credible piece of information. And I believe the QCAW, seasonally adjusted by Piper Sandler, is another critical piece of data. And the fact of the matter is, um, we won't know for sure because we want to compare the QCW after the Labor Department has seasonally adjusted it to the seasonally adjusted payroll numbers that we have at hand. But if there's no material new information, we're going to have something like a Six Sigma era between the payroll and the QCW in the fourth quarter.
Wow.
Now, we had during the '07 period, '07, '08, '09 period, we had an 8 Sigma era, which the BLS took a lot of heat for.
Hmm.
And so what they did is they revised the birth death model, but they didn't kill the birth death model and go to a different approach. When they did that, the BLS said, we solved the problem. And right now, we're supposed to be getting an error of plus or minus 0.1%. But we have a similar size error as we did apparently during the time period of the great financial crisis. They didn't solve the problem. That's the bottom line.
That's the bottom line. So, obviously, when you run an economy using flawed data, it's not that dissimilar to a pilot flying a plane with erroneous instrumentation, right? Very bad things can happen with bad data. So in your case here, you think we're flying into, and you haven't used this word, but I'm going to use it and let you correct me if you disagree. We seem to be flying into a recession, um, not realizing that we're doing that.
I feel that we are, based on what I see, we grew at a 1.4% annual rate in the first half. To me, it looks like that if you exclude the AI, which is hard to do, and you get into a debate as to what you exclude, it appears that all of the gain in GDP in the first half, the 1.4, was due to the AI. Maybe, and without it, you might have had an actual decline.
Mhm.
It's close enough to, it was either a wash or a negative. And so we're here in the third quarter. It looks like the economy is just creeping along. the two numbers that I kind of trust, maybe three. This is based on July preliminary information. Real personal consumption expenditures in July are at a 1.3% annual rate above the second quarter.
Okay.
But the trade deficit is subtracting like 0.4 or 0.5%. And government spending, US federal government spending appears to be down. I don't have any additional information. That tells me that based on those numbers, that the US economy is positive, but not by very much.
Mm-hmm.
And if you rearrange the components a little bit and just rely on hardcore things like domestic final sales, that's also only growing around a 0.5 or 0.6% annual rate. Not very much growth.
Not
And
very much growth, right? And not very much growth. So this is where I think the difference between averages and median is important. That growth, which is an average of the activity across the economy, to your point, is largely being driven by the AI sector, right?
it
So
is. It is.
yeah, so it's a small sector that's doing a lot of the work, right? Now, so
If you go ahead, Adam.
I guess my point is if you remove that part, if we're only kind of growing kind of anemically because the AI sector is keeping us positive, if you look at the rest of the economy, it therefore must be, growing very poorly or in contraction because despite the AI numbers, we're still only, only kind of muddling along. And where I'm going with this is it's that rest of the economy, which is where all the jobs are, right? The AI part of the economy doesn't have a ton of jobs in it. So I'm concerned about if we go through this Kindleberger spiral where you talk about, tariffs causing the margin squeeze, demand goes down, and companies that are caught between rising costs and having to cut costs because of reduced demand, we're gonna see a bunch of labor shedding in that long tail of the part of the economy that's not doing very well right now. And who knows? Maybe we avoid going into recession on average, but to many, many people, it may feel like a recession because personally, they've lost their jobs.
Mhm. Well, Adam, your point is very well taken. Um, do you have you ever interviewed Peter Bookwire?
Yes.
Very astute analyst, really digs into the data in detail. Peter calculated that if you look at the core capital goods shipments and orders, um, that the number we had a pretty good rise, from June to July, and you look at the first the first 7 months of the year, Peter believes that um, excluding the AI categories, that there was a net decline in everything else.
Yeah.
And it requires a lot of effort to do the calculation, and I have a lot of confidence in Peter. But another good friend of mine, David Rosenberg,
Hmm.
who has really outstanding team and staff, uh, I asked David whether Peter's calculation was correct, and he had one of his top flight economists and statisticians run the numbers, and it was very complicated because you're dealing with 12 different NAIC codes, but they confirmed that Peter's calculation was correct. And it doesn't matter whether you look at core orders or core shipments. Um, Once you exclude the NA, you're negative. In other words, the AI is booming and everything else is collapsing.
It's collapsing.
That's the
Okay.
basic picture, and that indicates that everybody says capex is doing well. This is an early sign that the immediate expensing that's part of the big beautiful bill.
Yep.
Is it work? No, I think it's strictly AI driven, and I don't believe that the immediate expensing works in an environment when the capacity use rates in the manufacturing economy is declining, and we're seeing an overall decline, which means that excluding AI, it's dropping pretty significantly. I think the pressure is already there. People typically, when you begin to deteriorate, you try to hold on, hopefully that it's a temporary event. But in this particular case, I don't believe that it's temporary.
It's temporary. Okay. All right. Well, look, Lacy, there's a bunch of key questions that, everything we've talked about tee up here. Um, how how bad could this get? How prolonged could it be? What do we expect to happen to interest rates and bond yields, which are an area of expertise of yours? What will be the knock-on effects in the financial markets? How might this impact treasuries, which obviously, that's what your firm Hoisington specializes in. We are going to get into all of that and more when you appear at the Thoughtful Money Fall Online Conference coming up in it's coming up fast, just what, a little over a month from now, month and a half. And then also, you will be joining us live after the official presentation and fielding live Q&A from the audience. So folks watching, if you have unresolved questions here, you'll be able
That's
to
one
ask
of
them.
my favorite things to do. You have such a great audience,
Thank
and
you. It is
they
it's
really,
such a joy to watch. The smart people in the audience get to ask questions of one of the smartest economists out there, and you're so generous in your time and in sharing your expertise, Lacy. So it's such a pleasure to watch.
well, thank you. I have to be really on the top of my game because it's like a batter who's getting uh, fast curveballs coming in on the inside corner.
Well, you've been batting 1,000 so far in your previous appearances at this, Lacy. So as we start to wrap up here, knowing that we're going to get into all that stuff, is there anything else that's really kind of weighing on your mind or burning brightly on your radar right now that we haven't talked about that's worth mentioning here?
Well, one of the things that we don't know is whether what the courts are going to say about the constitutionality
Of
um,
tariffs?
on the tariffs. We don't
Yeah.
know that. Uh, I personally think the administration had full authority under the 62 Act to raise the tariffs at least 15%. And their sector tariffs were, I think there's legislation that supports them. But I'm not a legal expert. I don't know, but I would have people to be aware of that. Um, uh, I just really don't know what they would do. It's a incredibly a difficult issue. Um, but assuming that we go forward with the tariffs, um, there is going to have to be a great deal of monetary support in the form of lower interest rates. Um, and I think that will reverberate across the curve.
Okay. I've got a lot of questions for you about that, but I'm going to hold off on them for the conference. Last question for you, Lacy, just before I begin the wrap up. Um, what are you optimistic about right now? We've talked a lot about pretty heavy things. Is there anything on the macro stage or even just life in general that you've got some optimism around?
Well, let me just, I'm not very optimistic right now. And one of the things that it's gnawing away at me, and this also goes back to Kindleberger and manias, panics, and crashes. And Kindleberger said that in manias, what happens is that you see valuations go to extreme levels.
Hmm.
Sometimes they're record, sometimes they're not record.
Yeah.
And if
Which,
the
sorry to
thing,
interject, but right now we can say check.
well, I'm going to run down them for you here. Just
Okay.
to answer. This is a great question. And also, there are significant risks that people dismiss because everything's so good and looks
Hmm.
so good. But let's look at certain valuations. Um, Burt Malkiel wrote a piece in the New York Times just in the last 2 weeks. Burt, who had the pleasure of knowing, wrote a great book, A Random Walk Down Wall Street, teaches at Princeton. His work led to the creation of the index funds, knows the stock market very well. He said that the price earnings ratios are amongst the highest in the last 230-year history. Um, uh, Another really astute money manager and uh, recognized thinker, Howard Marks. I don't know if you know that name.
I do. He's a phenomenal capital manager, very bright
Yeah.
man.
He calls the price earnings ratios a tent pole, and he cites work that looking at the forward PE ratios. They don't go back as far, only to the mid 80s. But the last time they were at these levels, um, the return on the S&P for the next 10 years was confined to a range of plus or minus 2%.
Hmm.
Howard also reminds us of where the where Buffett's favorite measure is, which is the market capitalization to GDP. That's at an all-time high. And you know, another thing that typically happens in manias is that you get extreme financialization,
Hmm.
and people begin to use new instruments that presumably protect you from any risk. Well, I'm not an
Like the
expert.
portfolio insurance of the late 90s, right?
Yes, and other forms of financial. I mean, there was very creative stuff being done, new stuff, and the refinancing of the railroad boom in the 1870s, and they kept the thing running for a while. But ultimately, the truth prevailed, and even in the time of John Law and the Mississippi and Louisiana bubbles, there was financialization. Well, one of the things now is this use of private equity capital. Um, my good friend Jim Grant has been talking about it. Um, the default rates have risen a great deal in the past year. In addition, a lot of the firms no longer paying interest. They're um, doing these so-called PIK extensions,
Hmm.
paying in kind. The vault rate, according to the latest calculations I've seen from the grant team, is that it's now over 11%.
Mm.
Uh, I mean, there are risks. There are risks that the tariffs are moving in the wrong direction. Another risk that people never talk about in terms of economic performance is the disastrous demographics.
Right.
We have weak demo. We're going to have one of the slowest growths in population in U.S. history, if not record, probably very close to it. The birth rates are coming down all over the world. The world economy, the key economies of the world are becoming older. You want young economies. That's another risk. Um, Another thing that's happening that everyone is ignoring is that the major economies are shifting more and more into command and control.
Hmm.
And what command and control economies do is that they make economies more inefficient, less productive. And so we have these significant risks, but no one is concerned about them because prices are high for a lot of things, makes people good. They feel that if it's okay with the markets, it's okay with me. But I would recommend them to go back and read Kindleberger. Um, because I mean these kind of mania situations can go on for a long while. But the thing that Kindleberger demonstrates is that after the mania, you have panic and then you have crash.
Hmm.
No one can time them, Adam. No one can time them. But it seems to me that that's the model that people need to be looking at very, very closely.
Okay. Super helpful. Um, all right. So I asked about optimism. You were kind enough to say, hey, look, I just don't feel that optimistic, and here are the reasons why. I'm going to put an optimistic spin on this.
Okay.
You tell me if I'm grasping for straws here, but it's that um, while all that is true that Lacy has just mentioned, and things may play out the way that history predicts they should here, so that the financial markets, the economy, the average investor may have tougher times ahead of them. You as an individual who educates yourself and positions prudently in advance of what is likely to happen from here, you can potentially change your destiny here to not become collateral damage to a lot of these concerns that Lacy mentioned. So that's the positive spin I want to put on here, Lacy, which is that
Well,
some
Adam, you're doing
education
a
and some
great job of
proactivity.
trying to have these very difficult, complex issues explained. And the educational service that you provide is exceptional. And I want to applaud you, and I want to tell you that I'm proud to be your guest again.
Well, thank you, Lacy. That's a huge honor, and I am very proud that you are a part of this movement, and even more proud to call you a friend. So
Well,
thank
we
you.
are good friends.
All right.
We
Well, let me wrap up here.
we're
And
such good friends. We've broken bread.
we have, and I'd love to do it again. And Lacy, at some point, there are some topics that you and I talk about. When we're off camera or hanging out or breaking bread, that I would love to have a conversation on camera with this audience at some point in time. And I don't think we're getting a chance to do it at the conference, but things like, you and I've talked about wealth inequality and the growing wealth gap, and I know that that's a very big concern of yours for just
Very
America's
definitely.
future
Well,
socially.
one of the problems of you see what here's I've talked about this in the past, but historically, um, from 1870 to 1970, we grew in real per capita terms 2.3% per annum. In the last 20 years, we've only grown 1.2% per annum.
Yeah,
That's
that's not going to do
40%
it.
lower. And it the government share is going up. We can see in great statisticians such as Hendrickson and Berg have shown that as we move into command and control, that the growth rate ticks down. It's only ticking down of 1/10 of 1% for every 1% increase in government. It's very imperceptible. But we've now lost 40% against trend. And unfortunately, whenever this happens, it exacerbates the income and wealth divides. It undermines your demographics. And so we have to understand that in actuality, for the last 20 years, the US economy has done very, very poorly. And we've left a lot of folks behind. And I don't think this is healthy.
So I'm right there with you, as you know, and I do think that topics like this are big topics that really deserve more time. So I'd love at some point to sit down with you and then just do a discussion around these things. Another one that comes to mind is on the demographic side is and this could be a sensitive discussion, but I know that you could handle it very well. which is, okay, now that we've essentially closed the border and we are, we're in the process of deporting some percentage of the illegal immigrants that have come here. It is, whether you support that or not, it is giving the opportunity to sort of say, okay, well, going forward, what should America's immigration policy be? And I don't want to put words in your mouth, Lacy, but demographically, it's very hard to see, if we want the economy to continue to grow anywhere near at rates that we had in the past, that we're going to be able to do that just with natural born citizens, at least at this point, with these low birth rates. So we're going to need immigrants, and immigrants have always been an important part of the American economic story. And I'd just love to hear your thoughts in greater detail than we have a chance to go into right now, that if you were given control of shaping policy going forward, what would be the key tenets?
No, we have to find a way to be able to um, to scrutinize applications, determine who coming here seeking economic opportunity, who is coming here to work with the system, expand the system, and not to destroy the system or lean on the system for support. Um, I'm reminded of Milton Friedman was such an economist. He was such a great economist. And he wrote on so many things, but one of the things that he said is that immigration has always worked to the United States advantage when people came here seeking economic opportunity.
Mm-hmm.
And we've got to find a way to do that in the concept, in the terms of the fact that we are a nation of laws, and we want to do this in accordance with the legal process. And it's going to be one of our highest priorities, and it's one of the ones that we need to be turning our attention to as soon as possible.
All right. Well, look, my friend, after the conference, after maybe the holidays, at some point in time, I'd love to roll up our sleeves together and dive into this, and maybe even do it in a live setting, so that the audience gets a chance to ask you some of those curveballs, let you take a swing at them
Okay.
yourself. But that's down the road. But folks, if you've had any interest in that, let us know in the comment section below. So in wrapping up here, Lacy, first off, thank you, and everyone, please thank Lacy.
Always
Let
a
him know how
pleasure,
much you
Adam.
appreciate him coming on by hitting the like button, then clicking the subscribe button below. Um, if you want to hear Professor Lacy Hunt go through his master class in what's happening in the macro world, and tackle those larger questions that I mentioned we're going to tackle in the conference, then please run, don't walk, to go sign up for the conference now. And you do that by going to thoughtfulmoney.com/conference. Right now, you'll get the lowest early bird price discount that we're offering, so do it quick, get there quick, and buy your ticket quick. And if you are a premium subscriber to our Substack, don't forget to look at your email. I've sent you a code that you can use to get an additional $50 off of that price. Last point, if you are, yeah,
Can I do a little advertisement here? No.
absolutely, go ahead.
Here's a great book. Can everybody read the title?
Hold it up just a little bit more. There you go. Kindleberger.
You see the title?
Yes, The World in Depression. This scares me, because I think you're going to tell me this is going to be really relevant for the next
Well,
decade.
it's why we need to understand that we don't have the same system. Then we didn't have unemployment insurance, we didn't have Social Security, we didn't have bank insurance, so we wouldn't go to depression. But it's the process of what happens when you have an extended period of beggar thy neighbor policies. And it's a great book. It's a very learning process from a
All right,
great.
I'm making a note to myself right here to go literally buy that on Amazon the second I get through with you here, Lacy. I think a lot of other folks watching will do so too. So folks will read it all together. And from those of you that are feeling a little uneasy, perhaps, about your personal financial situation, if the future plays out the way that Lacy thinks it may, then highly recommend you consider benefiting from the guidance of a good professional financial advisor, but most importantly, one that takes into account all the macro issues that Lacy has teed up for us here, and have them help you, come up with a a portfolio strategy and then execute that for you, that in a way that hopefully will help you avoid the worst of what might lie ahead and maybe even position you to profit from some of what might happen. If you've got a good financial advisor who is doing that for you, great, don't mess with success. But if you don't, you'd like an opinion from one who does, then consider scheduling a free consultation with one of the financial advisory firms that Thoughtful Money endorses. These are the advisors you see with me on this channel week in and week out. To schedule one of those consultations, just fill out the very short form at thoughtfulmoney.com. As a reminder, these consultations are totally free. There's no commitment to work with these firms. It's just a free service they offer to be as helpful to as many people as they can be. Lacy, look, I just cannot thank you enough, my friend. It's a very important time to get the experience insights of longtime experts like yourself. Very much appreciate you coming on, sharing so much with
I'm
us.
glad to do it. You're such a friend, and you such a great professional, and I'm glad to be associated with you, Adam.
It's such an honor, my friend. All right, well, look forward to seeing you at the conference. But until then, have a wonderful Labor Day, Lacy, and everybody else. You too as well. And thanks so much for watching.